Today I have with me Michael O'Brien at Fundsmith Emerging Equities Trust. Michael, it's been one of the most eventful periods in stock market history the past few months. Did you take advantage of low share prices during the crash?
I'd like to think so. We made 3 new holdings, which we've not necessarily finished buying, so we haven't disclosed exactly what they are yet. 2 of them were in technology, 1 was in retail. 2 of the 3 we bought after what I would call very material share price falls, and the third after a more modest fall. Of the 3 we've started buying, 2 were businesses we've known for several years, and the third was an IPO from last year. I think probably interestingly, and I'm sure we're not the only fund management house to say this, all 3 of the businesses we bought and what is happening out there as a whole are well placed to benefit from the trends which the pandemic is likely to accelerate: consolidation, formalization, and digitalization.
Is it just those 3 sort of ongoing sort of stake building exercises? Was there any other? Were there any other recent trades? And has have you been active recently? And if so, sort of what's in and out of the portfolio?
Okay, probably that recently we've not done too much. In the year to date, we've made 1 outright sale, which is a South African business called Tiger Brands, where not only alongside tough trading conditions, I'd got to a point where I'd felt management had lost their grip on the business. Elsewhere, year to date, we've reduced a couple of holdings where we felt there will be an adverse impact from reduced foreign worker remittances back into our home countries, which is unlikely to recover in the short term. I think it probably, if anything, needs to be looked at in a broader perspective of what we've done with the fund. If you look at where we were at the start of 2019, we had 45 holdings. We're now at 38. We primarily sold a number of holdings where we felt that the macro and legislative environment in the countries they operate in was too high. I think to put this into perspective, if you look at 6 countries, Sri Lanka, Bangladesh, Pakistan, Ghana, Nigeria, and South Africa, alongside Indonesia, the fund now just has a total of 5 holdings, whereas at the peak, this would have been over 15 holdings.
Okay. Why is that, Michael?
I think primarily it's macro risk. I think there's a degree of macro risk. If you look at countries rather, where there's high macro risk, you typically get currency risk. If a currency falls by, say, 30% over the course of an investment horizon, any stock you have to buy in that country has to increase by 30% for you just to tread water. And I think the other issue we have is clearly post-COVID-19, governments are going to be looking for revenues wherever they can. And I think if you look at a lot of the businesses we've sold, it would have been disproportionately in alcohol and tobacco, where I think governments in emerging markets see them as easy targets.
Normally, I'd ask a fund manager about a few of their top holdings or stocks of interest. I mean, I'd look through the top 10 holdings, names would jump out at you. But for the most part, that's not the case with your fund. Could you talk us through some of your most significant holdings? Perhaps some that viewers might not have heard of. Who are they? What do they do? And why do you own them?
Okay, I'll give you a couple of examples. And I'll start with Fosun Haitan, which is our second largest holding. It's the world's largest soy sauce manufacturer, which I assume most people have never heard of. You can probably find their products in most, and I say most with slightly tongue-in-cheek to it, Chinese supermarkets in the UK. Within China itself, it's got about market share of around 20% of the domestic market. It also manufactures a number of several other sauces and condiments such as vinegar, oyster sauce, hoisin sauce, and shrimp paste. The next largest player in the market has about 3% market share of the soy sauce industry. Thus, the markets in which Fosun operates are highly fragmented, giving it significant scope for growth. There's a major premiumization opportunity as China gets richer and its consumers become more discerning. supporting its market position are strong financial metrics, and I think these probably to us make it one of the standout companies in the portfolio. The business has grown sales at a compound rate of 21% over the last 5 years. Its operating profit has grown at a compound rate of almost 30% over the same time period. It has gross margins approaching 50%, operating margins of over 30%, and has almost 20 billion Chinese RMB in net cash on its balance sheet. Returns on capital are fantastic and well above the fleet average. ROIC for 2019 on an ex-cash basis was somewhere approaching 500%, and return on capital has actually increased every year for each of the last 5 years. It's got fantastic cash flow. If you're selling into the FMCG sector in China outside of a modern trade, you're typically not offering any credit terms whatsoever to your distribution base. And if you look at the group's cash flow conversion, it's consistently been well above 100% of profit for each of the last 5 years. And I think probably a second example, and I use this probably slightly more for your audience who have invested in a global equity fund as well, is FEET also is invested in retail, which isn't something that global equity fund has traditionally done, as we see it as a major formalization opportunity for investors. A good example would be DMart, which is one of the largest brick and mortar retailers in India, which has a market of somewhere around 800 to 900 billion at grocery retail. Formal retail is just around 10% of the overall market in the country, which suggests significant scope for growth. To put that into context, the modern trade in China is somewhere around 70%. The group emphasizes value retail to the middle classes, gains an advantage by selling products around 10% cheaper than any other retailer in the country by buying in bulk and limiting its range, and also focusing on operating efficiencies and owning its freehold to give it flexibility. This gives it a business model where its revenue per square foot is more than double that of its main competitor. And I think as well, in addition to the strength of value retail in a very large underpenetrated market such as India, DMart's main competitive advantage is picking the right assortment of products to sell. Our view very much as a house, if you look at any successful global retailer, the founder of a business understood the importance of picking the right assortment and was actively involved in picking the right merchandise through the early and medium stages of that business's progression.
It's difficult to ignore, obviously, the growth potential of emerging market companies, but clearly, if you want to get involved in some of these, they come at the investment there comes at a price. I mean, what do you think about current valuations, particularly in India, which you mentioned, and where you have significant exposure?
I think across all geographies, at present, the market is discounting short-term valuations because of COVID-19. So we're probably in a pretty unrepresentative stage of the cycle, if there is such a thing as a cycle. I think Indian valuations on paper may look expensive, but you've got to consider the quality of the companies we own. If you look at our portfolio against the index, you're paying a premium, but you're getting on average businesses with a higher rate of top line and cash flow growth, higher margins, a return on capital of almost 3 times that of the index, and what I would feel to be much better financial strength. And I think as a house and as a whole, particularly for this fund, we would also take the view at companies which are on multi-year growth trajectories can grow into their valuations.
I mean, India makes up, I think, 42% around that sort of figure of the portfolio currently. So you clearly like the region. And you've already said a bit about India, but is there any sort of other reasons, clearly, why you favour India? And do you anticipate any shift in the portfolio's geographic split, either further towards India or perhaps to other regions?
Okay, first, if we start with India, we're limited to a 40% threshold, but we can have a higher percentage if the share price of the companies in India we own basically carry us through that threshold. So that's why India is currently at 42%. So we can't buy net new percentage holdings. We can swap, but we can't buy new. So I think India is capped as what India's performance relative to the rest of the fund will be. I think in terms of India, it's not us really making a massive macro call on India. To us, everything we do is bottom up. We try and find the best companies we can invest in. And to us, India is a repository of some of the best companies we can invest in the world. And I think you're spoilt for choice in a number of areas. You have a large pool of listed multinational subsidiaries in India. You have national businesses and you have regional businesses. And India is a very difficult market to operate in. It's a country where factors such as distribution and logistics are a huge barrier to entry. In terms of elsewhere, probably worth pointing out that we've reduced the exposure to frontier markets to around about 9% of the fund.
Okay, Michael, look, thanks ever so much for answering our questions today. Thank you.
Thank you.